In this video, we're going to talk about market risk and how that is defined using this capital asset pricing model. Now, we're not going to discuss the theory in detail. We're really going to look at the concepts that the capital asset pricing model provides so we can use those in making some financial decisions. So let's think about first the market risk. How is that defined? Well, the contribution, when you create a portfolio, the stock contributes a certain amount to the standard deviation of that portfolio. How do you calculate that? W is the weight, or the percent that's invested in the stock. Standard deviation M is the standard deviation of the stock market. Standard deviation I is the standard deviation of the company. Correlation, this is the correlation between the stock and the stock market. So this will tell us, how does stock I, how much risk does that bring to a well-diversified portfolio? So beta, as a calculation, beta is a measure of market risk. It's actually very similar to the formula for correlation. So let's look at that real quick. Correlation is covariance between A and B divided by standard deviation of A times standard deviation of B. And we said that these two things, this correlation has to be between +1 and -1. But beta, this numerator is actually the covariance between asset A and the stock market. That is divided by the variance of the market, which again is just what? That's just the standard deviation of the market times the standard deviation, the standard deviation of the market, again, divided by covariance. So the formulas are very similar, except since this is the variance, it obviously makes a big difference here. And now this is just a simplified formula here. Covariance, actually, we would have to add standard deviation of M right there. So then this is M squared, right? So these would divide out. So anyhow, so the contribution of stock I to the standard deviation of a well-diversified portfolio, again, written again, it's just the weight, standard deviation of the market multiplied by beta. So again, if you're given the standard deviation of the market and the percent of the portfolio, beta measures the impact of stock on the standard deviation of the portfolio. So stock I contributes more risk, has a higher beta if it has a higher correlation, that's a higher relationship between the stock market and the stock, and or its standalone risk, standard deviation of I, is larger. So the greater the risk of the asset individually, plus the greater its relationship to the stock market, is going to give us an idea of how much does the stock contribute to the portfolio. So investors require a return for time, for tying up their funds. The risk-free rate is that investment we've talked about in previous videos. We proxy maybe a 20 or a 30-year treasury bond. So that risk-free rate is the rate of return you would expect if you invested in treasury. An investor, though, if you invest in a stock, you expect to get something more. You expect to get a risk premium. How do we calculate, or where does that risk premium come from? And of course, certain stocks are going to have a higher risk premiums than others because those stocks themselves are riskier. So the risk premium is the market risk premium. This is the extra return above the risk-free for just investing in the stock market. So if you assume you could only buy two things, the S&P 500 or a United States Treasury bond, how much more money do you earn if you buy the stock index rather than the risk-free rate? That's what we refer to as the risk premium sub M. So that's the risk premium of the stock market. But if you buy an individual stock, we want to know the risk premium for the individual stock. If you take the risk premium of the stock market and then adjust it by the market risk of that individual asset, that will give you the risk premium for the individual stock. What this creates for us is a basic formula. The security market line is the risk-free rate plus the risk premium of the individual stock. So risk depends on beta. The part of the standard deviation of the portfolio due to the stock, that's this beta, right? The weight, that's just proportion invested. This is the risk of investing in the stock market. So again, the required return of the investment ultimately requires or depends on the beta of the stock. So let's look at the correlations between the assets. We've done this a little bit earlier, but the correlation between Blandy and Gourmage is 0.11. Between Blandy and the market, 0.48. Between Gourmage and the market, 0.67. So just looking at this data, which one of these stocks do you think probably has a higher beta? It'll be the one with the higher correlation with the stock market itself. So now let's look at the formula. So how do you find Blandy's beta? It's the correlation, and then you multiply that by the relationship between the risk of the stock and the risk of the stock market. We end up with a 0.6. So the average beta equals 1. So Blandy's stock contributes less to a well-diversified portfolio than does the average stock. In fact, it's only about 60% of the risk of an average stock. Gourmage, on the other hand, has a beta of 1.3, which means it has 30% more risk than the well-diversified portfolio would have. So we would expect if you bought Blandy, you should earn a lower return than if you bought Gourmage because of the differences in risk. So plugging this into our formula, if the risk-free rate is 4, if the stock market return is 9, that means our market risk premium is 9 minus 4 is 5. Beta 6, 1.3. We see that if you were to buy Blandy, you would expect to earn 7%. You would expect 10.5 if you invested in Gourmage. So let's look at the actual returns for this. So the average company in the stock market should earn around 9%. Gourmage is a little bit riskier because of beta. It earns a little higher return. Blandy, a little bit less risk. It should have a little bit lower return. So again, this gives us a picture. Theoretically, if you were to buy these assets, this is the rate of return you should expect. How can we calculate this beta? Well, the easiest way to find beta is to look it up online through Yahoo Finance, Zacks, Kiplinger, Value Line has betas. all, Morningstar.com has betas. This one of the ways, if you wanted to do this yourself, would be to run a regression of the stock relative to the stock market. So here, this is a plot. This is Blandy compared to the stock market. And here you see a line, right? This line represents the line for forecasting. The intercept, so the rate of return on Blandy, according to regression, is 0.01 plus, now it's beta, 0.602 multiplied by, now what is that return on the market supposed to be? We said this is roughly 5%. So you should expect to get, right, at the beta of 0.602, you should expect to get in the ballpark, this is roughly 3, this says 4%. Again, it's a little bit off because we're only using a few data points, like 8 or 9 data points. So it's probably not statistically significant. In fact, if you look at the p-values here, they're both greater than 0.05. So because of the few numbers, we have some statistical issues. As I mentioned, you can find this almost anywhere out online. There's lots of places to find betas. Most stocks have a beta between 0.5 and 1.5. Certainly there are some very low, there's some very high. You might even find some negative betas from time to time. So how do we use this in investing? So first of all, let's think about stability. Is the capital asset pricing model, that line, the security market line, is it stable or does it change over time? So let's first think about what happens in an inflation environment. Inflation is part of the risk-free return. So if inflation happens, the entire security market line shifts upward. So let's say that you had this stock here. We find out it's greater than what the capital asset pricing model says. So you would like to buy this stock. But if inflation goes up 4%, now this stock is giving you a return that's less than what you wanted. So as events in the economy happen, the capital asset pricing model can change. It can turn perfectly good investments into not so good, and vice versa. If you think about individuals, when we move into recessionary times, especially deep recessionary times, people get very risk averse. So in this case, what you'll see is that the security market line shifts upwards, but it pivots on the risk-free rate. The risk-free rate doesn't change, but individuals' perceptions of risk change. So that's going to change the line. And again, some of these investments up here that were high beta stocks might have been good investments. Now they're bad. Down here, there won't be much change down here because the line doesn't change beyond that basis point. So let's continue. We just have a few more slides to talk about here with respect to beta. How do you calculate the beta of a portfolio? Very similar. It's the weight times the beta of the individual stock, add those all together. So it's a very similar calculation to how we calculated the return for a portfolio. So if you put 70% of your money in Blandy, 30% in Gourmage, that portfolio would have a beta of 0.8. If you plug that into our formula, if the risk-free rate's 4, the average return on the market is 9, beta's 0.8, you would expect on this portfolio, you would expect to get 8.05%. So let's see what happened in real life, right? How did this, given our data, what does this tell us about these stocks? So here's our portfolio manager, right? So this portfolio has a beta of 0.7, risk-free rates 4, market risk premiums 5. So based on the capital asset pricing model, the capital asset pricing model says we should earn 7.5%. Based on the capital asset pricing model, the portfolio manager for CC should have earned 11%. Now, in actual returns, when we look at the actual portfolio, JJ earned 8.5, but he only expected 7.5. So he overperformed. He performed better than capital asset pricing model said he should have. That's obviously then a good investment. On the other hand, 9.5% for CCC is not good, right? Again, given its risk level, we wanted 11. We only got 9.5. So it underperformed what the theory said. So what's wrong with this? What happened? One of two things is true. Either something is going on in the marketplace that investors are changing prices, or the capital asset pricing model is wrong. And either one of those things could be at play. We know that things change in the market. So again, if you think about it, anything above this security market line, these are good investments. You should buy them. Anything down here, these are bad investments. You should not buy them. In fact, if you own them, you should sell them. So that's it for this video on beta. Look forward to talking to you soon.